Meta shocked everyone with what they said during their Q2 earnings. But before we talk about what Meta said during their Q2 earnings that shocked the markets, first, let's do a quick recap of what happened in the stock market today. The Dow rose for the 13th straight day in a row, posting its best winning streak since 1987. Yes, I know 1987 was the year that we had the largest stock market crash in history, but just ignore that for a second. Let's talk about why the Dow rose this time. With the Dow posting its best winning streak since the 1980s, let's talk about why it keeps going higher. So far, there's no evidence of a recession, and so long as there's no evidence of a recession, the market will probably continue to melt up. Recession fears are easing in large part due to data showing inflation is coming down. In turn, traders are betting that the Fed will stop hiking interest rates, moves that have been restraining the economy's potential. And the key reason that strong economic data, along with weakening inflation numbers, can benefit the Dow more than the other indexes is because of the makeup. Many of the stocks composing the Dow are levered to an improving economy. Think about companies like American Express, Chevron, Goldman Sachs, and 3M. Funny enough, I own quite a few of those stocks in my Millionaire Club portfolio. I know I haven't given an update on the Millionaire Club portfolio in a little while. I, right now, have just been saving up cash, have not been making any buys because I wanted to wait to see how earnings came out before I made any decisions. But there were two stocks I added to the portfolio a few weeks ago that I do need to update you guys on. So I'll try to get an update for the Millionaire Club portfolio out tomorrow if possible. Now, let's talk about the companies that reported earnings today. We'll start with Boeing. Boeing posted a quarterly loss, but the stock surged as aircraft deliveries drove up cash. Boeing reported a loss of 82 cents per share versus 88 cents per share expected, which was much better than analysts had expected. Revenue also came in better than analysts had expected at $19.75 billion versus $18.45 billion. Now, in addition to the earnings beat and revenue beat, the real reason that Boeing skyrocketed on Wednesday is because the company generated $2.6 billion of free cash flow in the second quarter, which was ahead of analyst forecast, and they reiterated their full-year guidance of between $3 billion and $5 billion of free cash flow. And this is really important, especially for a company that's losing money like Boeing is. So long as that company can continue to increase their cash flow and they're not burning cash, then the company can survive and can continue to do well and not have to go out and do share offerings or take on new loans. And that's going to be good for shareholders, even if the company is losing money. And that's why Boeing hit a new 52-week high today. The stock rose almost 9% on the day. Now, yesterday, we talked about how companies are starting to lose pricing power and their profits are starting to suffer as a result. And nowhere was that more clear than when Chipotle reported earnings. For the past couple of quarters, Chipotle has beat analyst expectations because they had pricing power and they were able to raise the price of their products in order to increase their profitability. Unfortunately, it seems like that pricing power has now come to an end. Chipotle shares slid as sales fell short of Wall Street's expectations. Most importantly, Chipotle said last quarter that it's done raising prices. But of course, executives are open to another round of price hikes in an attempt to get earnings up. Earnings came in at $12.65 per share versus $12.31 expected, and revenue came in at $2.51 billion versus $2.53 billion expected. Now, you're probably looking at this saying, wait a second, Scott, the earnings came in higher than expected. Isn't that an earnings beat? But look at the fact that this is $12.65 adjusted. Specifically, excluding restructuring costs, closure expenses, and other random items, the burrito chain earned $12.65 per share. That's right, Chipotle just conveniently removed some of their expenses from their earnings And they're coming out saying, hey, look at us. We had these incredible earnings. We beat expectations. Yay! But they did so by just not counting their expenses. I mean, it would be like me coming out and being like, hey, this month, if you exclude all those bills that I had to pay, I'm a millionaire. Like, come on. This is so ridiculous. Chipotle is literally lying to you, trying to pretend like they had this great quarter, when in reality, the earnings were horrible. Of course, investors looked past Chipotle's shenanigans. They looked at the real numbers and sold the stock. Chipotle was down about 9% after hours. So when you look at a company's earnings, don't just look at the numbers in front of you. You've really got to dig into those numbers, because these companies will lie to you to make it seem like the stock is performing better than it actually is. Now moving on to what you really want to know, and that is Meta's earnings. Meta reported better than expected results, and they issued optimistic guidance for the third quarter. Just look at these numbers. They're unbelievable. Their earnings came in at $2.98 per share versus $2.91 expected. Revenue came in at $32 billion versus $31 billion expected. Daily active users came in at 2.06 billion versus 2.04 billion expected. Monthly active users came in at 3.03 billion versus 3 billion expected. And average revenue per user came in at $10.63 versus $10.22 expected. Literally every single number that Meta put out was better than expected. On top of that, revenue increased 11% from a year earlier, which was the first time the company has reported double-digit growth since the end of 2021. And on top of that, the company said revenue in the third quarter will be 32 to 34.5 billion, and that suggests a growth of at least 15% from a year earlier that Meta will report next quarter. Absolutely incredible earnings on Meta. No wonder the stock is up. Investors have been riding the Meta wave in 2023, expecting a rebound in the ad market and better profitability following the company's mass layoffs. Prior to Wednesday's close, the stock was up 159% this year. And the stock rose another 7% after hours. Now remember that I just said that when we look at these numbers, even if the numbers are great, we really have to dig into them to understand why the numbers were reported as they were. Because companies very often will pull shenanigans and try to hide things to make things seem better than expected. Now, when it comes to Meta, Meta is kind of using the same playback that a lot of other companies are using, in that their revenues really aren't growing that much. I mean, yeah, ad revenue is up a little bit, just like Alphabet reported an increase of 3%. It's a very small increase in ad revenue, really not a lot that would benefit the bottom line. The reason that Meta's earnings grew so much really had to do with the fact that they were able to cut costs. Not because there's a ton of extra advertisers coming in, not because businesses are spending more, not because consumers are spending more, but rather because they were able to cut costs. And remember, earnings or profits is just your revenue minus your expenses. So if you can lower your expenses, you can increase your earnings or profits without increasing your revenue. And that's exactly what Meta did. Total headcount at Meta declined 14% year over year to 71,469 employees, with Meta adding that only half of the employees impacted by the 2023 layoffs are included in our reported headcount as of June 30th, 2023, which means once the other half are laid off, total headcount will decline by as much as 30%. And that's really the reason why Meta's earnings are coming out so good. It's really not so much that revenue is going up in any kind of significant way. It's really the fact that they've done so many layoffs that they're now able to show an increase in profits because they're no longer paying so much in wages. Now, this is kind of good and bad. Well, it's good in the short term, right? Because it increases earnings, it increases profits, and of course, investors love it. But it can have some downsides in the long term. And when it comes to Meta, that's really what the focus is. It's the long term. How is Meta doing in the reality labs? How's Meta doing AI? What does the long-term growth potential look like for Meta? And unfortunately, the answer is not good. Meta's Reality Labs has now lost more than $21 billion since the beginning of last year. Reality Labs logged a $3.7 billion operating loss this quarter, and the unit recorded $276 million in second quarter sales, which was down from the $339 million in revenue it brought in during the first quarter. So Reality Labs is going in the completely wrong direction. Revenue is going down and expenses are going up. To make matters worse, Meta said in its earnings report that it expects operating losses in the Reality Labs unit to increase meaningfully year over year due to our ongoing product development costs in augmented reality and virtual reality and investments to further scale our ecosystem. And this is the reality when it comes to building new technology, especially when it comes to building out AI or any sort of virtual reality or augmented reality, anything that could be a technology in the future. The fact is, it takes many, many years to develop this technology. It costs billions and billions of dollars in losses up front in order to get the technology developed. And it could be 10 years or longer before these new technologies ever actually turn a profit and recover the losses that went into the initial development. And this is why when we looked at Microsoft's earnings and how they said that their AI growth was going to be very slow and it was going to be very slow and gradual over time. And now we're looking at Meta's growth in the same technology, and they're saying that their losses are actually going to increase year over year as they continue to develop this out. What we are seeing is the reality of trying to develop a new technology like AI. It costs a lot of money, it takes a long time, and the benefits of it don't show up in company earnings for many, many years in the future. So this has all led to a lot of the AI hype that originally pushed these stocks up to start to fizzle out a little bit. And investors are now starting to refocus and become a lot more concerned about what is going to happen very short term, how earnings are doing, how profits are doing. Those companies that are able to beat earnings expectations, like Meta, are going to get rewarded. And those companies that miss earnings expectations or provide bad guidance, like Microsoft, are going to get punished. Companies are no longer able to live on AI hype. It looks like the AI hype has, in fact, started to fizzle. And this is going to become very important when we look at the earnings next week, once we get Apple, Amazon, and especially Nvidia reporting earnings, and see if investors were still going to buy up those stocks at these extremely high valuations when the AI hype is dying down as reality starts to set in. Now, in addition to all of the earnings that have been coming out, we also had a Fed meeting today. And at that Fed meeting, no surprise, the Fed approved a rate hike that takes interest rates to the highest level in more than 22 years. The markets were pricing in a 25 basis point rate hike, which is 0.25%, and that is exactly what the Federal Reserve decided to do. That brings the Fed funds rate to a target range of between 5.25 and 5.5%. Now, what's interesting is that while the Fed has indicated that 2 rate hikes are coming this year, one that just happened and one more before the end of the year, markets are pricing in a better than even chance that there won't be any more rate hikes this year. But it's actually even worse than that. See, right now, the Fed funds rate is between 5.25 and 5.5%. And the Fed said they're going to do one more rate hike this year, which would bring the Fed funds rate to between 5.5 and 5.75%. Now, the current Fed funds rate is circled here in red. What I have pulled up is the results as of the end of the December meeting. So basically going through the end of the year. And right now, the markets are pricing in only a 3.6% chance that the Fed is going to do what they said they're going to do, and they're going to raise interest rates one more time. 96% of futures traders say that the Fed is lying and the Fed is not going to do another rate hike. 96% of futures traders are fighting the Fed. Now, 28% of futures traders think that this was the last rate hike and we're not going to get any more past this. But here's what's really interesting is that 58% of investors are pricing in the Federal Reserve cutting rates one time this year, and 10% of investors are pricing in the Fed cutting rates 2 more times this year. Now, that is a serious disconnect between what the Federal Reserve and Jerome Powell is saying and what the market is pricing in. The market's pricing in 1 or 2 rate cuts this year, and Jerome Powell's out here saying, no, not only are we not going to cut rates, we're actually going to raise one more time. And the market literally isn't pricing that in at all. Only a 3.6% chance that the Fed's going to do what they say they're going to do, and a 96.4% chance that the Fed is lying. Now, last year, the big saying was, don't fight the Fed. But this year, the stock market's been fighting the Fed all year long. In fact, I remember going into 2023, how the market was pricing in 0 rate hikes this entire year. And what did the Fed do? The Fed literally raised rates at every single meeting except for one this year. Literally the complete opposite of what the stock market was supposedly pricing in. Now, in a logical world, you would think that the stock market would sell off. It would crash because it wasn't pricing in all these additional rate hikes. But we haven't seen that. In fact, we've seen the stock market rally. And why is that? Why does the stock market continue to go up as the Fed continues to raise rates? Well, very simply, it's because normally when the Federal Reserve raises interest rates, it leads us straight into a recession. It crashes the economy. But so far, here we are halfway through 2023, 6 months after this recession was supposed to start. And not only are we not in a recession, we don't even have any signs that a recession is coming. The labor market remains extremely strong. Inflation is coming down. And despite the fact that the Federal Reserve continues to raise interest rates, the economy remains strong. So what is happening here? Where's the big disconnect? Well, there is a belief that a recession is still coming. Most people think a recession is coming. But there's a belief that the recession is delayed a lot longer than it historically would have been because of all of the money that was pumped into the economy during the COVID crisis. During the pandemic, the Federal Reserve pumped trillions of dollars into the economy. And that money to this day is still leaving the economy. It hasn't left the economy yet. And the result of all of this is that consumers have continued to spend. And this has allowed the profits of companies to continue to go up. But at some point, this will end. And the leading indicators, meaning those very early indicators that don't really show up in official Fed data, are showing the recession is very much so on the way. One of those is the fact that, yes, consumers have continued to spend, but They dug into their savings to spend. Now their savings are gone. Then they started to run up their credit card debt in order to continue spending. Now their credit cards are maxed out. And the latest data is showing that consumers are starting to refinance their houses in order to get cash out so that they can continue to spend. The fact of the matter is, the US consumer is not in a very good position. And eventually, at some point, the US consumer is going to run out of money and they're just not going to have anything left to tap into. Their savings are going to be gone. Their credit cards are going to be maxed out. Their home equity is going to be used up. And they're just not going to have any more money left. And once we eventually get to that point, and all signs point to it happening soon, sometime within the next 6 months, that is when we will finally see consumer spending start to go down. The other thing that we've seen is consumers have already been spending less and less money on goods and more money on services. But some indicators, such as those reports from Walmart and Target, show that consumers are actually just spending more money on necessities, such as food and gas, clothing. And because of all of this, there's a lot of leading early indicators that are showing that the economy is in deep trouble. But it hasn't really shown up in the official numbers yet because of the COVID pandemic. However, once all that stimulus from the COVID pandemic finally gets used up, we're going to be left with an economy that's in a world of trouble. For now, though, the economy remains strong. The stock market continues to go up, but some of these cracks are showing up in earnings as revenue growth starts to slow down. Yes, earnings are still going up because companies are cutting costs, such as doing layoffs, but the revenue growth has really stalled. And that's usually the very first thing that kind of fails. And then over the next couple of quarters, we start to see the actual earnings start to go down as well. And once that happens, then we got to deal with the fact that the Fed's raising of interest rates lags, meaning there's about a 6-month delay between the Fed raising interest rates and its impact on the overall economy. And we'll have to see how all of these higher interest rates are really hurting both consumers and businesses. And it probably is not going to be till the end of this year before we get a really good, true picture of how all of these Fed rate hikes are impacting the U.S. economy. For now, though, everything looks good. Stocks continue to go up, but we have to be mindful of the fact that the stock market is completely ignoring the Fed. They're fighting the Fed, and this could come back to bite them in the future. Now let's talk about some of the comments that Jerome Powell made today that moved the stock market. The first thing Jerome Powell said is that inflation is still a long way from its 2% target. While headline CPI has come down to 3%, it's important to understand that the Federal Reserve looks at core inflation as their preferred measure, and core inflation remains above 4%, which means the Federal Reserve still has a long way to go to get inflation down to 2%. Powell also said that the labor market remains very tight. And this is probably the Fed's biggest concern right now, because during the 1970s, as the labor market remained strong, what ended up happening is the inflation that was going down turned around and it started going back up again. And this is the one thing that the Federal Reserve does not want to have to deal with, because during the 1970s, it took 11 years to finally knock out inflation for good. The Federal Reserve doesn't want to wait 11 years. They want to get inflation knocked out for good now. And so long as the labor market remains tight and the labor remains strong, what that means is wages can continue to go up and workers can continue to have more money to spend on things, which means inflation will continue to go up. And the Federal Reserve does not want to see that. They want to see the labor market worsen. They want to see unemployment go up, because that is their indication that once inflation goes down, it's not going to come back up. Jerome Powell also reiterated the Fed's data-dependent approach, meaning they're not going to comment on future rate hikes other than to just say that they're going to play it meeting by meeting and just kind of see how the data comes out. Although stocks did turn higher as Jerome Powell said that the Fed could hold steady in September. Now, this was the Fed's plan that they had come out with in June, was to raise rates in July, pause again in September, and then possibly raise again in October. So this is kind of what we're looking at. Now, the markets did like the fact that they said that they would most likely pause in September. Of course, that was to be expected. What the markets are not going to like is if the Federal Reserve raises again in October. Jerome Powell also reiterated that the Fed expects below trend growth as the Fed continues to fight inflation and keep interest rates elevated. Now, what was interesting about the statement is that Jerome Powell said that while the Fed expects below trend growth, meaning they expect growth in the U.S. economy to be very slow this year, what was really interesting is that the Fed does expect growth. Even if that growth is very, very slow, the economy should still grow. What that means is no recession. The Fed is not expecting a recession this year. Now, we still might get one as early as Q1 of 2024, meaning about 6 months from now, but at least for the end of this year, the Fed does not see the U.S. economy going into a recession. Jerome Powell also said that the Fed is looking for proof that inflation is down durably. Until they get that proof, Jerome Powell said monetary policy will likely need to be more restrictive for longer. In other words, rate cuts are unlikely this year. Jerome Powell reiterating that rate cuts are unlikely caused the S&P and NASDAQ to shred the earlier gains and fall pretty fast. And this is where we're starting to see where fighting the Fed really is not working out that great, because every time Jerome Powell reiterates that they're not going to cut rates and that they're going to continue to raise rates and keep rates elevated until they see inflation come down, this is not what the market is pricing in. The market is pricing in one rate cut this year, possibly two, and Jerome Powell is reiterating, no, you're wrong. We're not cutting rates. Yet the market just doesn't get it. And every time Jerome Powell says this, the market sells off. So we're going to have to be very careful to see what happens over the next couple of days, and especially next week when Jerome Powell and some of these other Fed members start talking, because if the market starts to get scared about the fact that Jerome Powell isn't lying and he really is not going to cut rates, we might see some more sell-offs over the next few days and next week as Fed members continue to speak more after today's FOMC meeting. Now, the one thing to understand is if the Fed were to cut rates, there's only one way they would do it, and that's if we entered a recession. Only if we entered a recession would the Fed cut rates, because then they would have to in order to save the economy. So unless we enter a recession, there just aren't going to be any rate cuts. And right now, with the Federal Reserve not predicting a recession and pretty much nobody really predicting a recession for at least the next 6 months, the likelihood of any rate cuts this year is slim to none. And at some point, the market's just going to have to reprice that. So watch out for some drops in the stock market as other Fed members speak over the next, say, week and a half. Now, during this earnings season, as I explained yesterday, I've been making a few plays, not very many, just one main one really, and that was on Google or Alphabet. I told you yesterday how I bought a call, and today I would share with you what my profits were. Now, look, I've got no doubt that there are some YouTubers or TikTokers or Twitter people who are, sorry, not Twitter, what is it, X now? Some of those X-rated people who are coming out and going to show you some 300, 400% profits on their Alphabet, where they did some like weekly super risky call options and just got super lucky. Like, I don't play that game. I'm always going to try to manage my risk. My call options were over a month out, and the longer dated you go on an option, the less risk there is. So I'm not showing you a 300% profit, but it was still pretty good. I bought the GOOG call for $3.40, and then I sold it this morning for $7. It was a 106% profit. So 106% profit on my part, pretty darn good. Quite a few people in our coaching program followed on that play, and the profits were coming in anywhere from about 83% up to 136%. So really tremendous job. I applaud everybody who followed on that play and made money. Obviously, it wasn't here in the video because it was based upon some additional research that I had done during the day after the video was produced, but before the Alphabet earnings actually came out. So if you did follow on that play, congratulations. If you didn't, you want to get in on these trades and find out what we're doing. Here's the thing I got to talk about is a lot of people can show you these amazing one-off profits, right? You'll see these people that show like 300% profit here or 400% profit here, but of course they never show you their losses. What I am really interested in is not the one-off profits. Anybody who's lucky enough can have a one-off profit every once in a while and still be a losing trader. What I'm really interested in is consistency. Consistency is key. If you can be consistent at making money, you're going to do just fine trading in the stock market. And my head coach in the coaching program is just that. She is consistent. The small account that she uses for training purposes in the coaching program made $895 in May, $1,194 in June, and $656 month to date in July. So you see, the goal here isn't one-off big profits. The goal here is consistent profits. And that's really what I teach in the coaching program is consistent profits. If you want to learn how to consistently make money in the stock market using options, then come join my coaching program. I would love to teach you how to do it. The main coach who has consistently made money every single month, she is actually holding a special mastermind in August. This might end up being the last mastermind she does. So if you want to get in on that, I encourage you to go and do that, sign up. I have a very special promotion running now through the end of the month, and I only have a few slots left for this. What we're doing is we are running 20% off of the coaching program, and just for August and August only, I'm offering 30% off of that mastermind. So if you want to take advantage of that, now is the time. You have to get in before the end of this month. I only have a few slots left open. So if you want to do that, schedule a call with their onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. And if you got a lot out of this video, then be a good friend, share this video on your social media pages so that others will know what's happening in the market as well and why Meta rose, as well as how the Fed meeting affected the stock market. And don't forget to hit the like button and subscribe. And if you missed yesterday's video where I talked about all of the other earnings that have come out this week, make sure you watch the last video that I uploaded here.